Hello, clients and friends of Van Welden Financial Group, soon to be known as Van Welden Retirement Advisors. And everyone else watching this video, I'm John Van Welden, founder, president, and author of The Real Deal on Retirement. I'm going to keep it short and sweet today, but I need to share three important items: an economic outlook, a word on interest rates, and some investment insight. Number one, economic outlook. On the surface, the markets have been looking really good since the March-April tariff scare, which brought them down, some indices as much as 20%. But our spidey sense tells us there may be a lot more going on than meets the eye. Now, we never try to predict markets, but something about this current market feels eerily similar to 1999 and 2007. Back then, being cautious felt foolish. Markets were climbing and the last crash was far in the rear view. Everyone felt like they were missing out if they weren't on the train. But we all remember what happened next in both instances. The bottom fell out. Why am I telling you this? Because right now we are positioned extremely conservatively in all our strategies across the board, even more so than usual. We're witnessing enormous power shifts in global financial markets, and all the band-aids that were put in place back in 2008 are wearing thin. Remember, nothing was actually fixed. They just kicked the can. So where is this all headed and what's next? I have no idea. But our global economy is truly entering uncharted territory, and it's all being exacerbated by incredible advancements in technology that directly affects how money works on the most fundamental level. Our commitment to you, our clients, is to avoid taking on more risk than is absolutely necessary for you to achieve all your retirement goals based on your retirement income plan. So in times like these, when the stakes appear to be so incredibly high and markets already at nosebleed record levels, I'd rather be wrong and miss out on some upside or gains than be wrong and experience significant downside losses. Eventually, we'll gain some level of clarity and we'll loosen our belts again. But for the time being, we are risk off. That brings me to my second topic, which is interest rates. It appears interest rates are headed lower. In the short run, this tends to spook the markets and generate volatility. But in the longer term, it's meant to boost markets with cheaper money. Although we can't say for certain, it's probably not a bad idea to lock in rates for a year or two, or maybe even 3 on any excess cash. In fact, we've been getting lots of questions about this very issue. So our suggestion for cash is as follows. Number one, as always, keep your emergency fund in your local bank or your sock drawer. Whatever you do, make sure you have plenty of cash handy and don't worry too much about the interest rate. Remember, this is just a parking place for your emergency cash. It's not an investment. Number two, for money you want to keep liquid over and above your emergency cash, we suggest high yield savings account, or in our case, we use a cash management strategy. Currently, our cash management strategy is positioned 100% in treasury bills. That means it's 100% liquid and available, kind of like a savings account on steroids. That strategy is currently netting 3.5% after fees, but remember, that can fluctuate with interest rates. Thirdly, for money you can afford to put away for 2 or maybe even 3 years, we suggest a 2 or 3 year MYGA. And that's an MYGA. It stands for Multi-Year Guaranteed Annuity, which is essentially similar to a CD, except it's issued by an insurance company instead of a bank. The current rate for 2-year MYGAs is 5.15, and 3 years is 5.75. So again, we think it's a good time to lock in a decent rate before rates drop. Now, last but not least, I want to mention something about specific investments within some of our actively risk mitigated strategies. This was prompted by a question I was asked from a client the other day, and I thought it might be valuable to share with all of you the answer I gave him. we utilize a variety of active risk mitigation tools and strategies at various times, depending on economic conditions. One of those approaches uses options to provide protection against losses should markets drop suddenly. The trade-off is twofold. First, we are limited in our gains in exchange for the protection of our principal, much like an insurance policy for an investment. Secondly, the options we use deliver value over time as they mature versus in lockstep with the overall market. That simply means that one specific investment may appear to lag the overall market even more than we might expect until all those options mature and deliver their added value, typically towards the end of the investment term, which could be monthly, quarterly, annually, or even multi-year. To take this one step further, a strategy that's designed to protect 100% of your principal may even drop slightly during the investment term, only to have the option settlements replace those losses when they mature toward the end of the term. For that reason, monitoring these types of investments on a short-term basis can be very misleading unless you fully understand the underlying strategy and when it's scheduled to mature. Remember, the flaw of averages tells us that looks can be very deceiving when it comes to long-term investment success. I trust that all that makes sense, but if not, if you have any questions whatsoever, don't hesitate to reach out. As always, thanks for your continued trust and confidence from all of us at Van Welden Retirement Advisors.